Jim, welcome back to the Keiser Report.
I'm delighted to be here, Max.
All right, Jim Rogers, gold has had its worst quarter in 30 years. Is the bull market over?
Well, Max, that's a very good question, and partly depends on how you define bull market. As you may remember, in 1987, stocks went down 40 to 80%, and many people said the bull market was over. Was it over? In retrospect, no, it wasn't. Not at all.
All right, so...
And my point is that in my view, the bull market in gold is not over. It may go down another 20 or 30%, who knows, but by the end of this decade, it will be much higher.
Right, so the fundamentals that are supporting the gold market are still in place. Now, you did call for a pullback. Last year, you said you were looking for a pullback to satisfy, I guess, a healthy bull market has sharp pullbacks every now and then. Have we had that pullback now in this bull market? Are you satisfied? Are you buying, or are you looking for maybe a little bit more of a pullback?
I bought a tiny little bit just in case, but I would say, Max, I'm the world's worst market timer. I'm the world's worst trader, but I would suspect that a 30%, 35% pullback is not enough for it to make its final bottom. I suspect we're in the process of making a complicated bottom, which may take a few days, weeks, months, maybe even to another year or two. But then ultimately, gold will make its fabulous bottom, even if it's down 50% from its all-time high, and then we'll be off to the races again.
Okay.
Don't sell your gold, Max.
Fair enough. Okay, I want to stay on gold for a second. The price of gold is now lower than the cost of production for many gold miners. Barrick is writing down billions on one mine. So isn't this going to affect the supply of gold? And aren't the dynamics of supply and demand going to kick in here at some point?
Well, at some point. But, Max, I've seen many commodities stay below the cost of production for a year or two or three because people are very reluctant to close mines or close down oil fields or whatever it happens to be. You know, it's very expensive to close something down and then start it up again. So it can stay below the cost of production for longer than we like.
I want to ask you really to put on your journalist hat for a second, because you're in Singapore, you're in Asia, and you can give us direct man-on-the-street reporting whether this is true or not. Are people lining up in Asia, in Bangkok, and in other places to buy gold, physical gold at the shops? Is this true?
Yes, in April and even into May there was some of that, but that seems to be, I'm sure there's still people lined up, but it's not nearly as much as it was the first time gold dropped.
Now, Jim, you've taught finance and economics at Columbia University. How is it that their demand for physical gold is so large and yet the price goes down? How is that possible, Professor Jim Rogers?
Yes, the demand is large, but if you're talking about people in the shops buying gold, but there are more people selling the ETFs, and that's gold as well. A lot of people selling that form of gold, and that's why the price is going down. Gold has rarely, if ever, been set in the physical market, gold prices, any more than wheat has. Wheat prices aren't set in the physical market. They're all set in the futures market.
Are you in the camp that believes that there are more paper claims on gold than there is gold in the physical existence? And what I mean is, it seems that there's an agenda here. Those that are supporting the paper market love to see the price of gold go down, and they're willing to even manufacture naked claims against gold, so-called naked short selling, to make that happen. Are you in the camp of those who believe this is what's going on, or what are your thoughts there, Jim Rogers?
Well, the same what I said about wheat. Yes, the futures markets in wheat are much larger than all the wheat that there exists in the world and always has been. When you say naked short selling, Max, that's not the way everybody who sells in the futures market is selling naked. There's no such thing as that's how futures are. When you sell gold or oil or wheat or cotton, you're selling naked. You may have it, but most people don't. That's the way those markets work. It's not like stocks where you can sell naked shorts or you have to be long or you have to borrow it. You don't have to borrow in the futures market. You don't have to borrow anything. Just call up your broker and start selling, or do it on the internet now.
Right. People can simply call up their prime broker, they can establish a line of credit, and they can start selling short gold all day long, no matter what the actual fundamentals are regarding that commodity. Now, I want to switch gears and talk about bonds for a second. The bond market, many people, yourself included, I believe, have been looking for a top in bonds. The bond market seems to be having reached that point now in a 30-year bull market in bonds. Have we seen the top in this bull market in bonds? It's been going on really almost your entire career, Jim Rogers. We've had the bull market in bonds. Is there now a reversal?
The bull market started in bonds in 1981 when it made its low in September of 1981. Been going up ever since. Now, Max, I've called the top in bonds 4 or 5 times and been wrong. But fortunately for me, the last 2 times I've gotten it right. So I have no idea if this is the final top or not. I am short junk bonds, not government bonds. And you can ask me in 3 years if I got it right or not. I don't know if this is the top, Max, but I do know we're getting closer and closer.
All right, let me ask you about a comment made by Richard Fisher. He's the president of the Dallas Fed. He called bond traders, quote, feral hogs, likening their reaction recently selling bonds to the news of the Fed tapering, that is to say the Fed stopping their quantitative easing. He made the comparison to George Soros' attack on the pound. So here you have a group of market players that used to be called bond vigilantes and applauded for being bond vigilantes. Now Richard Fisher, the president of the Dallas Fed, is calling them feral hogs. Is that a bit unfair, Jim?
I know Richard and don't know him well, but I do know him, and he's a smart guy. I do know that whenever there's some kind of comment from the Fed or anybody else, people react. Come on, Mr. Fisher, you know that as well as I do. He used to be in the investment business. If people get a report about cotton, they go and sell or buy cotton based on the report. So this is the way markets work. Richard knows this. Mr. Bernanke, who's never been right about anything, came out and said X, Y, and Z. So the markets reacted. What is he expected to do? Everybody just to say, oh, did you hear what Mr. Bernanke said? Let's ignore it? Come on, that's not the way markets work.
Now, you mentioned Ben Bernanke, and you're a critic of Ben Bernanke and the whole methodology of the Federal Reserve Bank, which mimics more of a Politburo-style central planning than free market. Here in the UK, we have now Mark Carney. He has taken over the Bank of England from Mervyn King. He comes in from the Bank of Canada. He's being lauded here in the UK as a savior, as a rock star of economics, as almost a Jesus-like figure who will save everyone in the UK and Europe. Your thoughts, Jim Rogers?
Max, go back and look at every time somebody has been appointed to the head of a central bank in the past 20 or 30 years. They're always brought in as rock stars. Bernanke was a rock star. Greenspan was a rock star. Neither one of these guys had a clue what was going on. They got it wrong over and over and over again. But every time they bring them in, the press, because of the government PR, says these guys are geniuses and they're going to save us all. Unfortunately for all of us, these rock stars have turned out to be men with feet of clay, and they haven't known what they're doing, and they're going to lead us all into they are leading us into a serious problem. Well, Mr. Carney has said he will print money just like everybody else. That's not going to save us.
Right. Now, it seems that the philosophy of these central bankers, including Mark Carney, is to look at asset prices and bond prices as their price signal that they work off of. But they don't seem to take into consideration other areas of the economy that are suffering. So they have a very myopic view of the economy and what they're supposed to do to manage that economy. How could these central bankers expand their purview to be more effective, or should we just get rid of them completely?
Well, the world, let's go to America first. America's had 3 central banks in our history. The first 2 disappeared, as you know, and the world can get along without central banks. Now, these central banks, if we don't have central banks, Max, we have problems, obviously, could have problems. These central banks are worse than having no central bank at all. Fortunately, since they're making so many mistakes, at least in the U.S., we're going to get rid of them eventually. They're either going to go bankrupt because they're making so many horrible mistakes, or eventually the public's just going to say, these guys got us into such terrible trouble, let's get rid of the central bank, as has happened in the past. Let's look at the Japanese central bank, since that guy is hailed as a hero at the moment. You know, he has driven down the value of the currency, the Japanese yen, by 20–25%. Now, that's great for stockbrokers and people who own stock. But there are 125 million Japanese, Max, and every one of those people is now suffering because the cost of living is going up. Everything they buy, there's more and more inflation. Yeah, he's helping a few people, but he's not helping 125 million Japanese any more than Mr. Bernanke or Mr. Carney is helping the rest of us.
All right, you mentioned Japan. Let's stay in Asia here and talk about China. It was recently reported that banks in China are relying on short-term funding, which may evaporate at any moment. It looks like a bit of a Lehman moment when suddenly short-term funding evaporates, and of course that was part of the 2008 crash. What's going on in China, Jim? I know you're an expert on China, but it really looks like are they in a credit crunch, or is that overstated? What's going on?
Max, I'm not an expert on anything. I would like to be an expert on something, but China is certainly going to have problems. You may remember 15 years ago there was a big Asia crisis where most of the Asian banks were doing that. They were borrowing long and lending short, and the whole thing collapsed. I'm not sure that's what's going on in China right now. The Chinese government and central bank has been trying to cool things off for the past 3-4 years now. All you got to do is watch RTTV and you would know that, and most people should know that. And finally, it's becoming to bear fruit. They're starting to cool things off. It looks like it, and people are coming to them and saying, wait a minute, this hurts. This hurts. Well, it's supposed to hurt, for goodness sakes. When you cool things off, somebody has to suffer. Somebody's overextended. I hope China this time stays the course and does get rid of a lot of the excesses that have developed in China. They have too much inflation. They have a property bubble. They need to clean things out. Let's hope they do.
All right, Jim Rogers, we've got about a minute left. I wanted to ask you, again, something more of a philosophical question, putting your professor hat on for a second, and staying on China. China, the economy is really meeting now some environmental constraints. Now, according to people like Milton Friedman or other thinkers in economics, companies should never consider the environment. Their only obligation is to make a profit. That's their only obligation. But that kind of thinking in China and around the world is now meeting an immovable force called environmental catastrophe. So are you in the school where companies in China and around the world should just forget the environment, or they should try to mitigate their environmental damage, or is it time for another economic model, perhaps? Jim Rogers.
Well, Max, if your goal is to make a profit, that's fine, but you can't make a profit if you antagonize all of your customers. If your customers look out the window and they see horrible pollution caused by you, they're going to buy from somebody else. So you have to balance everything. Mr. Friedman is exactly right. The goal of capitalists is to make money. But part of making money is keeping your customers happy. And China now is starting to spend hundreds of billions of dollars cleaning up the horrible environment that has been polluted both in the air and in the water. Somebody's going to make a fortune, Max, cleaning up China, because they're spending a lot of money solving that problem.
Yeah, but those costs, of course, have been externalized off the company's balance sheet. It ends up on the government's balance sheet, and then the people end up paying this through higher taxes. So there's a bit of a mismatch with incentives and rewards. But anyway, Jim Rogers, we're out of time. Thanks so much for being on the Keiser Report.
Thank you, Max. Let's do it again sometime.
All righty. And that's going to do it for this edition.